Do you want to be rich in your 30s? Does the idea of financial freedom excite you? Imagine waking up on a typical Tuesday morning. The sun is shining, birds are chirping, and you're not worried about money. It's not because you've won the lottery or inherited a fortune, but because you made savvy investment decisions in your 20s. Investing isn't about becoming a millionaire overnight, it's about building wealth over time, and the sooner you start, the better. When we talk about wealth, we're not just talking about income. Income is what you bring home from your job each month, but wealth, that's your net worth. It's what you own minus what you owe. It's the financial foundation you build that can keep you afloat, even if your income drops. Wealth gives you options, freedom, and peace of mind. It's the key to living life on your terms. Well, it's not a dream, it's a reality that you can achieve with the right steps and decisions. Have you heard of the concept of compound interest? This isn't just your average interest. No, it's interest on steroids. Let's break it down. Compound interest is the interest you earn on both your original money and on the interest you continually accumulate. It's interest on interest, a snowball effect that can turn a small snowflake into a massive avalanche. Now, what makes compound interest so powerful? Time. The longer your money is invested, the more time it has to grow. Each year, you're earning interest on a larger sum of money. So, even if you start with a small amount, given enough time, it can grow into a substantial sum. But remember, compound interest isn't a get-rich-quick scheme. It's a get-rich-slow scheme. It's about patience, long-term thinking, and letting your money work for you. Compound interest is a powerful tool that can help you grow your wealth exponentially over time. Setting financial goals is the first step on your journey to wealth. Just like a navigator charts a course, your financial goals will guide you on your journey towards financial freedom. They are the compass pointing you towards your desired financial future. Now, you might wonder, what makes a good financial goal? Here's where the SMART strategy comes into play. Your goals should be specific, measurable, achievable, relevant, and time-bound. Want to be a millionaire? That's a great goal, but let's make it smart. How about aiming to save $100,000 in 5 years through steady investments? That's a SMART goal. Goals like these provide clarity, focus, motivation, and a clear timeline. They are the stepping stones that will help you cross the river of financial uncertainty. They give you a sense of direction and control over your financial future. Remember, a goal without a plan is just a wish. Investing always comes with a degree of risk, but how can you manage it? Well, let's unravel this mystery. Picture this. You're walking on a tightrope. One wrong move and you might tumble. That's the risk. Now imagine you have a long stick in your hands, spreading out your weight, helping you to balance. That's diversification. Risk in investing is like that tightrope. It's the potential for your investment to decrease in value or not perform as expected. This could be due to a myriad of factors, from market fluctuations to economic downturns. But remember, as with the tightrope, there are ways to manage this risk. Enter the hero of our story, diversification. Diversification is the process of spreading your investments across various assets, such as stocks, bonds, real estate, and more. It's like not putting all your eggs in one basket. If one investment doesn't perform well, you're not left high and dry because your other investments may be doing just fine. Think about it. If you invest all your money in the stock of a single company, and that company goes under, you could lose everything. But if you spread your investments across multiple companies or even different types of investments, the impact of a single company's downfall is lessened. And it's not just about different companies. Diversification can be achieved by investing in different sectors, different geographical regions, and even different types of investments. You could have a mix of stocks, bonds, real estate, and perhaps even some commodities like gold or silver. Remember though, diversification does not guarantee profits or protect against loss in declining markets. It's not about hitting the jackpot with high returns. It's a strategy to manage risk, to balance on that tightrope of investing. So next time you're planning your investment strategy, think about that tightrope walker. Keep your balance, spread your investments, diversify. Diversification is not about making high returns, it's about protecting your hard-earned money. Consistency is key when it comes to investing. This isn't just a catchy phrase, it's a fundamental principle that can make or break your financial future. Let's consider this. You've probably heard the saying, Rome wasn't built in a day, right? Well, the same is true for wealth. It's not about making a quick buck, but rather about steadily growing your wealth over time. Think of it as planting a seed. You can't expect a seed to blossom into a tree overnight. It takes time, nurturing, and yes, you guessed it, consistency. So what does consistency look like in the world of investing? It's not about checking your stocks every hour or trading every day. Instead, it's about having a regular schedule of investing, no matter how small the amount might be. This could be as simple as setting up an automatic transfer from your paycheck to your investment account every month. Consistency here is not about the size of your investment, it's about the habit of investing. Now let's talk about dollar cost averaging. In simple terms, it means investing a fixed amount of money at regular intervals, regardless of the price of the stock. This strategy can be a game changer. Why? Because it takes the guesswork out of investing. You don't have to worry about timing the market or making the perfect trade. Instead, you're buying more shares when prices are low and fewer shares when prices are high. Over time, this can potentially lower the average cost per share of your investment. Remember, the stock market is a roller coaster. There will be ups and downs. But if you stay consistent, you'll be investing through the highs and the lows, smoothing out the ride. So let's recap. Consistency in investing is about regularity, not quantity. It's about sticking to a plan and not getting swayed by the market's ups and downs. It's about using strategies like dollar cost averaging to take the emotion out of investing. And most importantly, it's about understanding that wealth building is a marathon, not a sprint. Consistency in investing can help you build a significant nest egg over time. So stay the course, keep investing, and let time and consistency work their magic. Investing is not just a financial journey, it's an emotional one too. It's a ride filled with highs and lows, anticipation and suspense, euphoria, and sometimes disappointment. But here's the key. You have to keep your emotions in check. It's easy to get swept away by the thrill of a soaring stock or the panic of a plummeting one. However, making investment decisions based on emotions can be detrimental to your financial health. Panic selling when the market takes a dip or buying based on market hype can lead to poor decisions and potential losses. It's crucial to stay calm, composed, and stick to your investment plan, regardless of market fluctuations. Consider the market as an ocean with waves of volatility. Your investment strategy should be your boat, steady and resilient amidst the waves. Avoid making impulsive decisions driven by fear or greed. Instead, focus on your long-term goals and let them guide your decisions. Remember, the stock market is not a roller coaster that you should get off when it's moving. So, to wrap up, investing in your 20s can set you on the path to wealth in your 30s. The magic of compound interest is a powerful tool to grow your wealth. It's the phenomenon where your earnings generate even more earnings over time, creating a snowball effect. The earlier you start, the more time you give your money to grow, and the heftier your snowball becomes. Setting financial goals is also crucial. Whether it's to buy a home, start a business, or retire comfortably, having a clear vision of what you want to achieve can guide your investment decisions. It's like having a destination in mind before setting out on a journey. You wouldn't embark on a road trip without knowing where you're headed, right? Understanding risk and diversification is another key step. Investing isn't about putting all your eggs in one basket. It's about spreading your investments across different asset classes to minimize risk. Think of it as a balanced diet for your portfolio. You wouldn't only eat cake for every meal, would you? Consistency is the glue that holds all of these components together. Regular, disciplined investment, regardless of market conditions, can lead to significant wealth accumulation over time. It's like going to the gym. You can't expect to get fit after one intense workout. It takes consistent effort and discipline. Lastly, keeping your emotions in check is vital. The market can be a roller coaster ride with highs that make you feel invincible and lows that make you want to quit. But remember, investing is a marathon, not a sprint. Keep your emotions in check, stay the course, and you'll reach your financial goals in time. Start your investing journey today, and you'll thank yourself in your 30s. Remember, the best time to plant a tree was 20 years ago. The second best time is now.